Hello everyone, and thank you for joining us for today's presentation as part of the Industry Insight webinar series. The topic this time is 2017 year-end accounting checklists and tips. Speaking today will be Erica Bristlier of Cosmolex. Erica Bristlier is the Director of Strategic Communications at Cosmolex, developers of an all-in-one cloud-based legal practice management, billing, and trust accounting system specifically designed for solo and small law firms. Erica's degree is in business administration, and she has over 6 years of experience in the legal software industry, catering to the specialized technology needs of small to mid-sized law firms. Erica has given numerous presentations across the country on legal technologies such as law practice technology management, cloud computing, and legal billing and trust accounting compliance. The presentation today will be followed by a Q&A. Please enter your questions into the question box in the webinar panel on the right side of your screen. All questions will be addressed at the end of the presentation. We're recording this webinar and we'll be sending a video and a follow-up email in a few days. We'll also post the video on our blog at www.lawtechnologytoday.org. Thank you all for joining us. We'll now begin the webinar.
Great, thank you so much. So as stated, today's topic is basically focus on accounting, 2017 year-end accounting specifically, checklist to go with that, but also tips for 2018. So just an overall agenda. Now that the year is ending, this is really when accounting and bookkeeping is really on everyone's mind or is about to be. You start thinking about that towards the year end. So this is definitely a great time to talk about some tips which will hopefully help you going forward. And to start, we will be taking a little bit of time just to understand law firm accounting. Before we get into tips and ideas, we do want to overview exactly what we're talking about with legal accounting, what makes that different from just any other business. And we'll try to present the material in as simple words as possible. I do recognize that lawyers are not accountants. While some of you might have an accounting background, that's not your forte. That's not where you choose to spend the majority of your time. So we do try to keep it as simplified as possible, but accounting is an advanced topic, but it's necessary for any business in order to get a good handle on your accounting. The checklist. So there are many things that need to be completed at the end of the year, and I'm going to highlight the most essential items today, but we will leave you with a fully detailed checklist for you and your accountant to have as a reference. So look for that towards the end of the webinar. Of course, tips for the new year. The best way really to conquer your accounting is to start on the right foot. And now's really the time to kind of reflect back on your past year, see what perhaps you could have done differently or better, and start the new year off fresh. So we'll take some time on that. And the last piece is how can technology help? Much of what I'm going to talk about today addresses legal specific challenges, and the tools that you use can help or hurt your efficiency or even your financial accuracy. So we'll talk a bit about what that means and how some tools can help you with some of the tips and challenges we'll be talking about. So with that, let's dive into legal accounting. What are the components of legal accounting? So unlike any other business, I mean, every business of course has to deal with accounting, but there are legal specific components to be aware of. So there's three items that are what build up legal accounting. First is business accounting. And this is what really any business needs to deal with. This is pretty standard accounting activities like worrying about your profit and loss and your balance sheet, which we'll be talking about today as well, making sure all your income and expenses and your general ledger is set up properly. That's across any business, no matter what. You have to worry about that end of year reporting. But there are legal aspects to that, which are more so the next 2 points that are also essential for law firms. You need to think of matter costs or income accounting, meaning I'm paying those out-of-pocket costs. How are those booked from an expense perspective? And also when I'm receiving a payment, maybe an invoice payment, how is that booked from a revenue perspective? Fees versus costs are handled very, very differently and much different than any other business. So it's important to know that. And then the last piece is fee advances or retainers. So this is where trust accounting falls into play. Also, if any other type of retainers are allowed in your firm or accepted in your firm, this is where you need to worry about things like compliance, knowing what is kind of a regulation of not just federal level, but state level, being aware of the guidelines, being aware of what to do and not to do. And here, a lot of the times, more so with retainers or settlement funds or whatnot, client funds, that money is not yet yours in many scenarios. So when that's the case, due diligence is really needed. You have to be very careful in how that money is maintained and make sure you're keeping good records from that. Now, these three are not isolated components. They all interact with each other all the time. And this is part of what we'll be kind of talking about today. The end of year accounting affects all three of these areas. And now that we understand the overall topic, we're going to walk through kind of a top level review of the end of year checklist to assist you in wrapping up this year's accounting. Note that, as I mentioned before, following the webinar, we will be providing you with a full length checklist, and we'll also send that in the follow-up email as well to have as your reference. So this is by no means, there's not enough time in a webinar to cover all the activities you need to do end of year, but we're going to highlight the main points and provide you with the material to really go through step by step in great detail. So our first area to talk about is reconciliation. Now, the funny thing is reconciliation is probably the most important item to complete just from an accounting perspective, but it's often the most neglected accounting task, surprisingly enough. Surveys show that 30% of businesses stay on top of their bank reconciliations, and a whopping 50% haven't reconciled for 6 months or more. So that, of course, would be requiring a lot of end-of-year catch-up. It's an even bigger issue when you're dealing with IOLTA or trust accounts, of course, but you need to keep all bank accounts in mind. Reconciliation is important just to make sure everything is taking place properly and any mistakes are being addressed. If you have reconciled regularly, then a lot of this step should already be complete when the end of year comes, which is, just think about that. All that preparation and doing things as you go will kind of cut out a big chunk of end of year work. However, that's not the majority, as we mentioned. So if you're part of that 50% who have fallen behind on your reconciliation, then here's a few steps to keep in mind. So the first is clearing transactions. You do want to clear your transactions carefully. With so many transactions, there's likely quite a few with the same amount or even the same name. So you want to be sure to clear the ones that correspond to the statement that you're reconciling. So have a close eye on the items that you're comparing and clear them properly. Are there transactions in your bank statement that don't match what's in your books? There could be maybe a check written in your system or your records for $250, but the bank has $2,500. Is that just a mistype, and on which end? Is it the bank error or is it in the system itself? Or maybe the payee is registered in your system, but the check was actually written to cash. So there's a lot of things to keep in mind when reconciling, a lot of variations. The more consistent you can be with the way you're not just recording your transactions, but the way you write your checks is always helpful in time of reconciling. This is definitely the first line of defense to uncover fraud or embezzlement. I do know a lot of firms where they have staff who have written a whole bunch of checks to either cash or to themselves, and therefore taking money from the firm. So while you don't have to be doing the reconciliation yourself, it depends on the roles in your firm, how much staff you have, if any. You don't have to do the reconciliation. Somebody else can do that, but you should be opening up your bank statements and you should be requesting the reporting each and every month to ensure everything is good to go. Now, of course, you're going to end up with uncleared items. That's pretty standard, but as you're completing this process, let's say at the end of the year, are there uncleared items that are, let's say, 6 months or older? You need to research these. Were they just entry errors? Is there maybe a vendor that tends to hold on to checks and then maybe deposit them all at the end of the year? Maybe there's an outstanding bill which the check is supposed to be applied. There could be different scenarios for uncleared items, but you need to be well aware of what those are and to be able to address those. Uncleared deposits, same thing. Are there maybe entry errors? Did you batch several payments together, but you didn't clear that deposit in your system? Some of these could be just due to entry error or mistakes, which is fine. That's the easiest to fix, but you need to go through these steps in order to uncover those items. Bank fees. You want to make sure that any fees are entered and also cleared. So since those fees are posted by the bank, they do appear on your bank statement, of course. It's very common for law firms to kind of get nervous when their statement doesn't balance and they can't figure out why. And very often it comes down to fees, wire fees, bank fees. Those will come in and you likely don't have that record in your system. So if you're ever not matching, first think about the fees. And you don't want to use an adjustment to enter fees. You want to use that as a specific expense account that's designated for those types of fees. Some additional points, if you're handling credit card statements, that is a big part of law firm expenses. So you also want to make sure that you're not only capturing those expenses, but if there's any finance charges or interest or late fees, that has to be captured as well. Also, if there's any cash rewards, maybe you get 5% back on your credit card and it's a statement credit, that has to be considered as well. A great way to really stay on top of that is to use either an import function where you can import your credit card statements, or even a bank feed that connects your system with the bank so that the transactions feed in. So you will get all of those finance charges, late fees, even rewards. Those will all show up in your records because it's coming directly from your credit card bank. So definitely helpful if you have a lot of transactions you're maintaining on a credit card. And of course, like anything, you need to make sure to reconcile your credit cards. Many people don't think about that. You need to make sure you're accounting for every single expense and that they're posted to matters. You may be paying for filing fees on your credit card and forget to post them to your clients. So therefore, you're not getting reimbursed for those expenses. So verify that as well. That's very specific, obviously, to law firms. And the last item, this is a tricky one, making adjustments. There are several types of adjustments, but one question about the most is month-end reconciling. Like you reconcile your account, you're off by a little bit, what's the reasonable adjustment? If you're reconciling a trust account, the answer is none. You should not be adjusting or making an adjustment entry for anything dealing with a trust reconciliation. You need to sort out the discrepancy and resolve it that way. For the operating account, you want to determine and really talk with your accounting professional, your bookkeeper, your accountant, because there is no one standard. Sometimes it does depend on the type of work that you do, the type of, if you happen to have any funds in the operating account, that can factor into it. So do speak with your accountant for guidelines on that. And before you make any adjustments, you want to look carefully to see if there's any like transposition errors. You might have just switched some numbers around, could have just been a typing mistake, and that's of course the easiest way to resolve an error. Keep in mind the tools that you use. We mentioned how tools can help or hurt you. Some software will allow a user to accept an adjustment no matter how large it is. They could say, I want to make a $1,000 adjustment, and the software say, okay, no problem. And be aware of that, because just like even in the trust account, if a system allows you to do a $1,000 adjustment in a trust account, that's not a good thing. So you need to be mindful that not all tools are going to prevent you from doing things you shouldn't be doing. All right, and last point is with adjustments posted to an expense account, which will affect your profit and loss, and highlighted for your accountant to review at the end of the year. Your accountant should be going through any adjustments that have taken place and make sure that they are made properly and not just, a staff member could never reconcile and they keep adjusting every month to make the books balance. That is not a proper way of adjusting, and that is something that the accountant needs to make sure is not being done. Our second main item is the trust account. So there's a few different areas when dealing with trust. First is the client retainer balances. Things to consider. Is the work complete on the matter? Maybe you billed the client and you're supposed to get paid from a retainer, but maybe you forgot to transfer that payment from trust to the firm's business account. Very common, especially in smaller firms, to just slips the mind or thought it got done and it did not. So ensure that if the work is completed, that those funds are earned and removed out of the trust account. End of year is a great time to just double check all of that. When was the last transaction? Maybe this matter is dormant or closed. Are you expecting to do any more work? If not, close that matter out. It will make your books a lot cleaner. And if the work is done, you've been paid, and there's a remaining balance, you must refund that balance. Okay, and year end is a good time to do this cleanup. See if the work might have been completely done. You might have $20 sitting there in the trust account. Now that amount matters. How much is remaining in that trust balance? Some retainer agreements, so you might have an agreement with your client, specify a minimum that will not be refunded, like maybe less than $5 or whatever the amount you may have. So keep that in mind. It could be pennies, it could be $3. That might be absorbed by the firm, but it all depends on your agreement with your client, and it's important to have that in your retainer agreement. If $20 is left over, it won't be refunded, or whatever that amount is that you choose. All right, also client trust activities. Are there outstanding transactions to be paid on that matter? Have your settlement funds cleared, especially if you're dealing with anything like personal injury, and those settlement funds have to be deposited. Make sure those have cleared. Have all bank fees been taken? Now, bank fees should not come out of the trust account. Ideally, those should come out of a connected operating account, but either way, because some banks do it improperly even today, make sure that they are accounted for. Were there funds held to pay expenses? Like maybe you had some taxes on a real estate transaction and you held on to those funds because you had a future expense that you knew what was coming up. Have those expenses been paid? If not, if it has been paid, and again, there's remaining funds, you want to refund those remaining funds. And the last part, which is always important with trust, is you need to run a three-way reconciliation report after you've made any adjustments or cleaned up your account. You want to make sure all of your balances are correct. For trust, it really is essential to have clean reports printed or maybe even saved for future reference, because you might be audited or somebody may question something, and you want to make sure to have, not only for yourself, to be able to see everything balances out, I'm good to go, and have a clear conscience about it, but to have that record is so important with the trust account, because you often may need to prove it to somebody else. So make sure you keep copies of your reports, both on your computer and also backed up, so you have those accessible. Reviewing the profit and loss, that's your third step. So since most firms report on a cash basis, you want to run the appropriate reports to compare your total fee income and also your invoices to make sure that everything matches up. Now, some software have reports like sales by customer or collection reports, which will let you know the income brought in on each invoice. And this can help you identify how much of receivables is outstanding, but also maybe things have been misposted. Maybe you earned a payment on an invoice and somehow it got posted to the wrong account. Comparing that billing type of report, which is invoices paid, and the income report will help you verify that everything was posted properly. Reimbursable client costs. So this is an expense account, a client cost account. And there's two accounts. There's the account that the cost gets posted to, and then there's the income side of it. When it eventually is reimbursed, the money will come in there. At the end of year, or whenever you happen to be looking at these accounts, they might not necessarily match because there may be expenses that have not been reimbursed. So you need to run appropriate reports to determine what has not been paid and how long these expenses have been sitting there. How aged are there? Is there a good likelihood that you'll get paid? Is this something that you need to write off? Or is it something that's fairly recent and you think you're going to be paid fairly soon, which is the point of a reimbursable client cost. Those costs are when you're expected to be paid in the near future. If it's no longer the near future and it's taking longer than it should, then it needs to be addressed. Also, general expenses. Those, like you might have a general expense account on your general ledger. Those are for basic office expenses, maybe rent or payroll. And a review of these expense accounts should include any mispostings. So again, a lot of this reporting is meant to find mistakes. Perhaps you have client costs that snuck into your general office expenses accidentally. Those should belong to reimbursable client costs, so make sure they're in the right account. This also is a good time to ensure that expenses that have a liability component, like payroll, a big part of payroll is a liability. You want to make sure that too is posted correctly to the liability count and those steps are satisfied. Balance sheet. So the balance sheet comes down to these 4 points. Of course, it is the comparison of assets, liabilities, equity, and owner's draw. It is a snapshot at any given point in time to basically let you know what all is current in the firm as of that date. So in terms of assets, did the firm acquire any new assets during the year? You want to make sure they're on the balance sheet. Any depreciation, has that accrued according to your IRS schedules? You want to make sure that's accounted for. Advanced client costs, those are client costs posted to an asset account, usually used for more long-term cases. If you're not sure how your client costs should be posted, speak with your accountant, because it does depend a lot on the type of work that you do. But again, for those types of costs, review transactions, make sure they're accurate, check for any expenses that have not been recovered, and note if anything needs to be written off. What liabilities does the firm has? And that does include the trust account. Trust does factor into liabilities. You have long-term liabilities. You know, when are they open? You might have some loans or anything else that might be taking place for the firm. Do the payments that you're making reflect the debt service agreement? Are payments being allocated to the correct debt? Because you're managing your debts here as well. Short term, same thing. When are they opened? For a line of credit, are you required to have a balance for 30 days? You know, you want to make sure that whatever written into that debt agreement that they're being satisfied. So if you have multiple loans or debts taking place, you need to make sure you're following the guidelines for that particular agreement. And then equity and owner's draw, how our partner or owner draw is allocated. You want to make sure that owner expenses are allocated to this owner's draw account as well. Check with your accountant to make sure that legitimate firm expenses are not allocated as owner's draw. They should be completely separated out. And if you need help, because every firm, again, has different types of expenses, different categorizations, speaking directly with your accountant will help you to classify what goes where. And some other reports to keep in mind, accounts receivable. You want to generate all these reports as of December 31st. So you want to make sure you can pull an AR report, which could be a billing report, or some accounting systems allow you to kind of switch to accrual reporting and can give you an accounts receivable report that way. You want to look for invoices that are aged more than 60 days. And then go ahead and either create a dunning letter or some sort of notification to your clients to reduce those balances. It's a great cleanup for end of year. Client balances as of, again, December 31st. Are there any open invoices? Pay those from those retainers. Maybe something missed. We mentioned that earlier. Sometimes money doesn't get taken out of trust. Are the matters active? If they're not active, make sure you are issuing refunds for any of that remaining balance. We covered that before as well. And the last point is for 1099 miscellaneous for non-employee compensation, meaning any vendors that have been paid for various services. If it's more than $600, then you need to file a 1099. So you want to make sure to run a vendor report, make sure you have all of your EIN numbers or social security numbers, whatever you need to file those forms. Prepare a 1099 form for each one of those, and also a 1096. That's a compilation form. You want to make sure that both of those are completed for any vendor that you've paid more than, I believe it's $600 per IRS standards. And some remaining accounting activities. So you want to run a trial balance report. That's basically a summary of your general ledger and all of the balances at the end of the year. Make adjustments if needed, following the guidelines that I spoke about. If your software doesn't automatically move, so this is the end of year thing, your net income needs to move to the balance sheet. If that doesn't happen automatically on your profit and loss, you have an income and expense summary, or a net income needs to be moved to either retained earnings or owner's equity. Some softwares do that automatically, some do not. So just be aware of that and know if your software does not, that you need to do one journal entry just to move that item over. And you need to close your books effective December 31st once all this is done. That will avoid accidental edits or any changes to the books for the prior year. Now, that is the overall summary of the checklist. We're going to talk about some tips to keep in mind. Like I said, you want to be able to start the year off right, so that way if you're struggling end of year to get your reporting and cleanup done, then you know next year I want to start off differently to make it much easier process going forward. So a couple tips to keep in mind. You do want to use a legal specific chart of accounts. That helps you quite a bit because your chart of accounts, also known as a general ledger, that is the foundation of your bookkeeping. Each and every transaction you do will impact two accounts. One would be debited, another would be credited. So and that's literally the heart of your accounting. All of your accounting takes place in your general ledger. So you want to make sure that the specific needs of your law firm are addressed here. Your system should be customized to have this unique set of accounts. It could be everything as simple as you need an advanced client cost account, or maybe you have different areas of practice and you want to allocate your income that way between the different practice areas. Or you might have some sub-accounts you want to create for your office expenses. This is what defines your reporting. So the step is to your chart of accounts or your general ledger. Once that's set up the way you want it to be, then your reporting will come out the way you want it to be. And here's just some examples of some legal specific accounts. I mentioned client cost accounts, trust accounts, fee income. Anything related to this, you won't have in a general accounting software, so you do want to make sure that you have what you need for your firm. IALTA accounting. So of course, as mentioned, this does require due diligence to be compliant. Proper bookkeeping is really needed, not only for smooth reporting at the end of the year, but we do know that there are consequences if your books are not cared for well. Especially when you're dealing with client funds, you need to make sure there's an extra responsibility there to make sure they're being handled properly. Couple things to keep in mind. Should never commingle your funds between clients. If you have a system that does not separate out by matter or by case and things easily get moved around, or it's not clear what you have for each case, then you might want to reevaluate that, because it is essential for trust accounting to know at any given time what balance you have for that particular matter. Also, you cannot overdraft. If you have $2,000 for a matter, you should not be cutting a check for $3,000. It is so easy to do if your system allows you to. That could be a general accounting system, or even if manual or Excel. Obviously, you could do whatever you want with manual records, which is often the struggle because it's too flexible for your trust account. You need to have that three-way reconciliation report, as I mentioned before, and you need to make sure that being aware of the tools that you're using is very important. If you're using a legal-specific trust accounting solution, they should be able to provide really out-of-the-box compliance if it's legal-specific. If you're using a generic method, ensure you're aware of the guidelines and what has to happen, and make sure that's enforced in your firm. So from an accounting standpoint, it is important to know that trust funds are a liability, which is a balance sheet item. It is not yet income. A lot of people record that incorrectly and are therefore inflating their income. Ensure you're recording this properly. Only when earned should those funds be moved out of the trust liability account into your operating, which would be an income account. You want to make sure you have full coverage of your client costs. This is one area where you could be preventing the loss of income greatly. I know so many firms that lose income because they pay a cost out of pocket and they forget to post it to the matter. And usually it's just the workflow you have or the types of tools that you're using. So ensure you have a system where typically if you have the billing and accounting together, that's very helpful to make sure that you're booking that cost and also billing it to client at the same time, that prevents that whole gap there, where usually that cost is lost and not reimbursed. Ensure those costs are being posted properly. I mentioned this earlier. Advanced client cost is an asset account. Reimbursable client cost is an expense account. If you don't know how your cost should be booked, speak with your accountant. And indirect costs. Anything dealing with overhead that you need to be reimbursed, those too need to be tracked, and they need to be posted to indirect cost accounts. And then allocating your revenue receipts. I mentioned before that you want to record your income properly, and in many systems, like let's say QuickBooks or generic systems, they will take that payment and just apply it proportionally to everything. So if you have a $1,000 invoice payment and you receive 800, it'll take that 800 and kind of apply it proportionally down the list, which is not correct. It should go towards actually in this order right here. So it's going to cover anything related to client costs first, any other charges like late fee or finance charges, and then fee income is absolutely last. You might have some partial payments where you haven't earned fee income, and that's okay, but it's important to know that. So that way your income is being recorded properly, and especially if you're compensating anybody in your office based on fee income brought in, you want to make sure it's being properly calculated. And the last piece here is dealing with duplicate data entries. You want to make sure that whenever you're using separate systems, there's going to be an entry that has to happen in both. So imagine the amount of keying entries that can happen. And it's not just the error itself, it's once it's found, fixing the error could be a nightmare. So you want to reduce duplicate data entry as much as possible, and don't 100% rely on two systems like syncing with each other. Not all syncs work. Usually there can be issues. So you're still, even though the systems are syncing together, you need to make sure that they're matching, reconciling regularly, verifying that things are correct. And if there's a mistake, it can be quite hard to fix. So stay on top of that as much as you can. Just an overall point with a lot of the challenges that we talked about. If you have your billing and accounting separate, that's where a lot of the accounting issues come into play. For instance, trust account. That affects billing and also accounting. It's a liability on your balance sheet, but it's also a retainer for your billing. And when the systems are separate, it can fall right through. Costs cannot be reimbursed. Income can be allocated improperly. So just keep that in mind if that's something that you're currently experiencing. If you're forgetting to post those costs, or you know you're not properly allocating income, keep that in mind, that bridging this gap by bringing the two together could be very helpful. And my last point here, I do want to show you all at least what Cosmolex has to offer, and then we'll get to our checklist. We are an all-in-one web-based application that has it's legal specific with billing, legal business accounting, trust accounting, and all the different activities all wrapped into one. So everything that we talked about, properly recording your trust funds, ensuring that your client costs are recovered, allocating your income properly, because a legal specific tool driven to attorneys' needs will satisfy that.